First of all, I would like to thank the organizers of this workshop for giving me the opportunity to present my paper here. It's a pleasure to be here. And let me start by giving you kind of broad picture of what this paper does and how it can be placed in the perspective of systemic risk regulation, since we are talking here about systemic risk. So what I'm doing in this paper I'm trying to address the design of capital regulation for a bank, which can be seen as a systemically important bank, in the sense that if this bank is engaged in a kind of moral hazard or in kind of misbehaviors, and these misbehaviors finally lead to large losses in this bank, this will impose negative externalities on the whole banking system and even on the whole financial system. So you know that the landscape of the modern banking system is characterized by presence of these institutions, of these so-called CIFIs, systemically important institutions, and their presence actually represents a big headache for regulators, because everybody knows that these institutions can benefit from explicit or implicit government guarantees, and actually the regulators do not want these CIFIs fail. So this actually induces all kinds of misbehaviors in CIFIs and pushes them to take on excessive risk. And in particular, in this paper, I am addressing the problem of tail risk, the risk of infrequent but very large losses that may have negative externalities. So what is the role of capital regulation here? The role of capital regulation here is actually to discourage the systemically important bank from engaging in manufacturing tail risk. And one of the major points I'm going to make here is that capital regulation can be used in order to launch a kind of incentive mechanism that would induce the bank to abstain from engaging in tail risk. And this mechanism is strongly tied to the shareholders' incentives to recapitalize the bank in a timely fashion. So the necessary condition that I'm going to show that will help to prevent tail risk in the banking sector is shareholders' interest to maintain their bank operating, so to recapitalize the bank in a timely fashion. But I want to be very transparent on the following point. Even though I'm addressing capital regulation from the systemic perspective, so the reason of being for capital regulation here is backed by systemic concern, the approach I'm taking to modeling capital requirements is a kind of standard approach to capital regulation. So I'm dealing with a single representative bank, but it will be enough for our purposes, because in the end, capital regulation will kill incentives to engage in excessive risk taking, and actually all systemic consequences might be avoided. So let me now go a bit deeper into the very motivation of this work, because so far I was given a kind of broad picture. So this is the true motivation. Actually, this paper was inspired by the experience of the recent financial crisis, and maybe you remember that after the crisis there was a big outrage against bank managers who were blamed for taking on too much risk. And actually, the crisis itself can be viewed as a product of tail risk, of excessive risk accumulated within the financial system. So the very common view is that these excessive risk-taking behaviors of bank managers were actually induced by perverse incentives embedded into existing compensation schemes. But if we recall what we know from the contract theory, we know that actually incentive compensation is supposed to align somehow the incentives of a principal and an agent. So if we follow this logic, it seems that bank shareholders themselves wanted their managers to take on excessive risk. And indeed, there is some empirical evidence pointing out on this fact. But if we follow this logic again, so it seems that the current crisis was not only the consequence of corporate governance failure, but it was also a failure of the existing regulatory system, because the whole sophisticated set of bank regulation, especially bank capital regulation, which seems to be quite complicated. So this whole set of regulation failed actually to incentivize bank shareholders to care about the quality of risk management in their bank. So once faced with this question, with this problem, one may ask what was actually wrong with the existing capital regulation. So I'm not going to discuss here the whole list of drawbacks of Basel capital regulation. I would rather bring your attention to a couple of particular points that are relevant to this study. And the first and probably most conceptual point I would like to make here is that capital regulation failed to adjust in time to the changes of the bank business model. You know that over recent decades, banks actually shifted their focus of activity from traditional banking activities toward what we call market-based activities. And basically this shift also was related to the emergence of new kind of risk. And one of these risks is so-called tail risk. So this is a risk which materializes very infrequently. So most of the time banks do not care about it, but if it materializes, it imposes very large losses in banks, and these losses may have systemic consequences. The whole point is that tail risk is actually inherent to many strategies banks are trying to use to increase their profits. For example, we may think about this strategies as aggressive subprime lending, especially when it's combined with securitization techniques. So at some point, banks thought that they can easily use securitization to unload risk from their balance sheet, and actually this decreased their incentives to care about the quality of these loans, but they failed to realize that in the end they ended up of holding the senior tranches of the securities, of asset-backed securities they issued, and actually they ended up of being exposed to the risk they manufactured themselves. So this can be actually seen also as a kind of manufacturing systemic risk. Less extreme example of tail risk might be involved in any kind of illegal activities like floating tax evasion. For example, this is particularly relevant for Swiss banks, or fixing large LIBOR rates, because these kind of activities may end up with huge fines. And the last year was particularly fruitful in this sense for many banks. Anyway, for banks, these kind of tail risk strategies was quite interesting because banks could generate excessive profits in the short run, but these excessive profits actually came at the expense of large losses. And capital regulation, the problem with capital regulation was that it failed to adjust in time to this changed nature of risk-taking in the banking sector. So it seems that the existing levels of capital regulation were simply insufficient to curb these new risk-taking behaviors of banks. The second point that is related to this study is that capital regulation was all time focused on the incentives of bank shareholders, on the risk-taking incentives of bank shareholders, without actually taking into consideration that there might be a huge conflict of interest with respect to risk-taking between bank shareholders and bank managers. So let me be more precise on this point. So we all know that the risk profile of the bank is actually chosen by bank top managers and not directly by bank shareholders. And in the modern banking system, it seems that bank managers are not actually risk averse. Sometimes they want to take even more risk than shareholders would prefer, and in particular they may have particular interest to engage in tail risk strategies. And there was this paper by Nataliya and Popin, in which they're illustrating this point very well. So they show that the increased competition for managerial talent in the modern financial system enables managers to easily move across firms, and actually this feature enables managers to pick up tail risk projects that may materialize, so this tail risk may materialize only in the long run, and in the meantime managers can benefit from excessive profits and from higher compensation, and then they can just switch the firm, the bank, before this tail risk materializes. So it's very difficult in this context to deter managers from taking unfair risk. So if it is costly for bank shareholders to prevent their managers from taking unfair risk, they may simply let them do what they want. So especially if capital requirements are low, if capital regulation is too lax, shareholders simply do not have enough skin in the game. So they will just prefer to tolerate this tail risk rather than to bear high cost of financial compensation. Sorry, I don't know how it works. But can you hear me without this thing? So I will just continue. So what I'm exactly doing in this paper? In this paper, I'm designing the incentive mechanism that would that illustrates how capital regulation can be used to prevent banks from taking untail risk in the presence of the internal agency problem. And actually, the key idea that is conveyed by the model that capital regulation can be used to implicitly control the risk-taking incentives of bank managers. So this is just the illustration, the big picture of this incentive mechanism that will be illustrated by the model itself. So here, actually, we have two layers of moral hazard problems or agency problems at which. So this problem concerns the choice of risk management quality in the bank. And in fact, bank shareholders may want to take more risk. Actually, they may have incentives to have tail risk strategies implemented in their bank, whereas it's not socially optimal. And on top of that, bank manager, the top bank manager, may have additional incentives to engage in tail risk. So, in fact, this internal agency problem between bank shareholders and bank managers with respect to the choice of risk management quality can be easily resolved by the appropriate incentive compensation contract. But this contract is costly for bank shareholders. So as to induce bank shareholders to put this contract in place, so the regulator should adjust capital requirements in a way to incentivize bank shareholders to care about risk management quality in their banks. So this will work like the provision of incentives by chain. And some review of the results. So the first point I'm going to show you is that capital requirements alone, like leverage ratio alone, will be simply unable to discourage bank from engaging in tail risk. In contrast, capital requirements combined with shareholders' incentives and ability to undertake recapitalization of their bank in order to comply with this capital regulation. So such capital regulation can prevent the bank from engaging in tail risk. And the third big point I will try to make is that the presence of the internal agency problem in banks actually calls for high capital requirements. So now let me finally go to the model. So the model I'm going to show you is a continuous time model in the spirit of classical Bayesian model. This is a model which is widely used in corporate finance literature. And throughout the model, or agents are risk neutral, and its current future at a constant risk R. So the subject of this model is a bank, which is financed by the mixture of insured deposits and equity. And on the asset side, we have only one class of risky, illiquid assets. So I'm not making a distinction between safe and risky assets. All assets is simply risky. So these risky assets delivers a certain payoff to shareholders. So certain cash flow to shareholders. So this cash flow is proportional to the size of bank assets, and the size varies over time. And shareholders can use this cash flow in order to pay interest to deposits, and the rest is distributed as dividends. Now, so this is just the snapshot of the bank balance sheet. We have risky assets. So the value of these risky assets moves over time. We have deposits so their volume is fixed over time, and book value of equity is just a simple difference between the value of assets and deposits. Now, our bank is run by a manager, so this is a kind of senior manager. And at each time instant, this manager can choose risk management strategy. So basically, the choice is between two technologies, so-called prudent risk management and imprudent risk management. So what's the difference? The main difference between both is that imprudent risk management enables the assets to grow at a higher pace. So the bank assets is growing at a higher expected rate under imprudent risk management than under prudent risk management. But in contrast, imprudent risk management faces the bank with tail risk exposure. So tail risk here is modeled as large losses whose arrival follows a pulsing process with certain intensity lambda. And if a large loss occurs, so it will destroy a proportion of bank assets value. So here, alpha xt will be the remaining value of bank assets after a large loss occurs. So the main interest for bank shareholders to have tail risk strategy implemented in their bank is the possibility of having high expected assets growth. But for the manager, there is an additional interest to implement this imprudent risk management technology. And this is related to the possibility to extract, to generate some private benefits, so which are, for simplicity, assumed to be proportional to the size of bank assets. And actually there was an example of this kind of behaviors. So there was a Bank of Commonwealth in US that failed a couple of years ago, and actually the senior management of this bank was engaged exactly in this type of behavior. So the management was providing, so this bank was providing very poor loans to clients in return of some private favors. So this can illustrate actually these private benefits collected by the management. So let me just put this risk management quality choice in a more formal way, so as to be able to write down the dynamic of bank assets value. So we introduce the indicator of risk management quality. So this indicator equal to 1 designates that prudent risk management is implemented in bank, and S equals 0 designates the presence of imprudent risk management in bank. So having this, we can formalize the dynamic of bank assets value, and actually the assets value represents a single state variable in this model. So this equation simply tells us that the variation in the bank assets value comes from three terms, from three components. So the first term here reflects the increase in value referred to expected assets growth. And we can see that it is lower actually under imprudent risk management. Now, under prudent risk management, sorry. So the second term reflects the changes in bank assets value coming from volatility risk. And the last term appears only under imprudent risk management, and basically it reflects the possibility of experiencing large losses in the bank. Basically, this expression simply illustrates a trade-off between faster asset growth on the one hand and the asset safety. And so it illustrates the trade-off related to the choice of imprudent risk management strategy.
What's lambda?
Lambda is the probability of experiencing a large loss. So it's the intensity of Poisson process.
So in some sense, assumption 1
Yes, I'm making.
predicts what you will get, right?
Sorry?
Assumption 1 predicts the outcome of your model.
Well, in some sense, I need to have this assumption in order to have the revelation here. So this assumption tells that imprudent risk management is socially inefficient. That's why we want to avoid it. So actually, this will
I mean, here you phrase it in this way, but if you forget banks, you could also think of this as a model for venture capital. Suppose you invest in risky projects.
True.
So most of the firms will fail. One of them will become a blockbuster. And you could also think of it in the same way. You will have you could think of the gains from the venture capital in the same way. So and so one way of thinking about this tail risk, but to think about tail risk as the necessary,
So you find that I can put it in a more broad perspective, not especially for banks, right?
yeah, I mean, there is tail risk, as you
True.
frame it, but you could also frame this in the context of investment. So if the banks want to lend to companies,
Mm-hmm.
or, well, lending to small businesses is a risky venture. Many of them might fail.
Yeah, I see your point.
Statistically, this is validated. Some of them will grow. So you could also, and in that case, you could have different stories.
Yeah, actually, I see your point. This is a very nice remark. This is a different way to interpret possibly this theory. Thank you. And well, another assumption I'm making here is that without any regulation, shareholders would actually never to recapitalize the bank because new equity issuance is unattractive. So the investment in risky assets here is less attractive than investment in riskless technology. But under regulation, we will see shareholders actually will prefer to recapitalize.
So there's no risk return trade-off there, right? So when you take on risk,
So
you
here,
lower the
actually,
risk.
I'm working in a risk neutral world. So, for example, mu. So this return on assets is already adjusted to risk.
Right, but I mean, so if you take on the risky behavior, you lower the drift and you take care of it, right?
Yes.
So I think what Rama had in mind was something where there's a risk return trade-off. So
And
by
it-
taking on risk, you increase your return.
okay, I
Whereas
see.
here, you take on risk, you lower your return.
Yes, indeed. So it lowers the
So is the
No, no,
jump process
sorry.
compensated or not?
sorry.
Is the jump process compensated?
No, actually, maybe I said something wrong here. If you take on tail risk, you actually increase your return
Oh, I see.
because so imprudent risk management makes your expected return higher. So it's
Negative plan.
yes, yes.
So what's delta?
Expected return is lower.
Sorry.
What is delta mean?
Delta
prudent
is
one,
the
right?
difference between expected return in case of a prudent and prudent risk management strategy. So if you choose prudent risk management, so basically this delta is subtracted and you experience
Yeah,
lower
lower,
return.
Oh yeah. So there's a risk return trade-off. Yeah,
It's
sorry.
it's
I
it's a
got
way
the
around.
one minus in the yeah.
Okay.
That makes sense.
So thank you for
Okay,
this
thanks,
comment,
yeah.
at least. Now it's clear. So let me introduce a new player, new actor in this model. So now we have the third actor, who is bank regulator, and bank regulator here wants to prevent the bank from taking on tail risk. And as I said in the beginning of this presentation, this is driven by systemic concern. So if there is a large loss in a bank, and especially if it brings the bank into distress, this may have negative externalities. So the role of the regulator here is to get rid of tail risk. And another assumption is that capital regulation here represents the unique regulatory instrument. So if I have time in the end, well, I don't know whether I will have, I will try also to make a discussion about complementing capital requirements by payout restrictions. But in the baseline version of the model, I don't have them, so I only work with capital regulation. And in order to deal with capital regulation, so I'm following here the existing literature which adapts the incentive-based approach to capital regulation. So there are a couple of studies cited here. So in this literature, capital regulation is modeled in the form of leverage ratio, and basically it is implemented in the form of a critical regulatory threshold. So it is a critical value of bank assets, such that if the current bank assets value falls below this threshold, the bank is liquidated. So it's not about physical liquidation, but it's rather about wiping out existing shareholders and transferring bank assets to new owners. But in this literature, for example, so these studies were dealing with capital regulation in the context of asset substitution problem. So basically the problem was what regulatory threshold to choose so as to prevent the bank from increasing volatility risk. And basically the main contribution of all these studies was to show that if we set this regulatory threshold relatively high, so if we simply pick a high leverage ratio, so we can completely get rid of asset substitution problem to prevent the bank from increasing volatility risk, which corresponds to this sigma, for example, in our model. In this model, the story will be a bit different because the nature of risk is different. So now we are talking about the risk of large losses. And one thing I'm going to show is that simply increasing leverage ratio would be insufficient. So we must combine this increase with the fact that capital regulation ensures that shareholders will be willing to recapitalize banks to inject new equity into the bank. So, and this is actually the main new point of this paper. So in this paper, I allow for the possibility of bank shareholders to have the option to recapitalize the bank. And basically, the recapitalization here means the assets expansion. So shareholders issue new equity in order to buy new assets and to expand the asset size of the balance sheet. And so here, to be consistent, I allow for two types of recapitalization costs, proportional and lump sum costs. And all these costs can be related first to equity issuance costs, and also they may refer to the cost of asset adjustment. So the rest of my talk will be structured as follows. So first, I'm going to show you that we really need capital regulation in this framework, because otherwise the unregulated bank will always have incentives to engage in tail risk. And I will also show that without the possibility of recapitalizing the bank, shareholders will also always to choose at some point tail risk strategies. The second part of my talk will be related to the design of capital requirements for a non-management bank. So I will try to abstract for a moment from the agency problem and just to show you how the mechanism works. And finally, I will show you the full picture in which capital requirements are designed in the presence of the internal agency problem. So let us take a look first at the incentives of bank for risk-taking in the absence of regulation. So here, assume that there is no agency problem, no regulation, and bank shareholders, or the manager of funds on their behalf, should select risk management strategy. Basically, this choice is made contingent on the state of the bank asset value, which is the unique state variable. So the choice of risk management here is made so as to maximize bank equity value. And actually, by the standard dynamic programming arguments, we may see that equity value will satisfy Bellman equation. And solving this, we can obtain a simple condition which tells us that it is always optimal to stick to prudent risk management as long as the expected cost of imprudent risk management actually exceeds the expected gain from imprudent risk management. So this expected cost simply reflects the expected loss of bank equity value when imprudent risk management is implemented. And this expected gain is related to a higher, is produced by a faster asset growth under imprudent risk management. And what can be shown also, so I'm not doing it here, just believe me, this is one of the results of this paper. I'm showing you that at some point this condition does also, it simply means that there is some region in which shareholders or managers will be willing to implement, to engage in tail risk. So to sum up, tail risk is unavoidable in the absence of regulation. Now, assume that we have capital regulation in terms of this leverage ratio or the regulatory threshold. So capital regulation applies, but it's not possible to undertake asset expansion. So it's not possible to recapitalize the bank because it is prohibitively costly. So it means that in this case, there is no way to avoid mandatory regulation. So at some point, when the bank asset value will fall below the regulatory threshold, the bank will liquidate it anyway. So what happens here? Actually, here it happens that it always turns that a distressed bank will always engage in tail risk. So why? Because here there is a kind of trade-off between volatility risk and tail risk. Let me illustrate this point. So actually when the asset's value moves across time, it can be drawn down by the adverse realization of volatility risk. And at some point, so it becomes very close to regulatory threshold, and shareholders will feel the threat of seeing their equity wiped out. So what they will do at this point, they will try to somehow hedge against the further negative adverse realization of volatility risk, and they will take tail risk, which brings the high expected assets growth and actually may help the bank to move away from this dangerous region and thereby to escape liquidation. So in other words, when it's not possible to comply with capital requirements via asset expansion, via recapitalizations, tail risk is unavoidable because shareholders will want to protect themselves from the failure, from the bank liquidation caused by volatility risk, and they will engage in tail risk. So it's a kind of gambling for reservation behaviors which are present here. So that's why, as I'm arguing, there is a strong need for inducing recapitalization. And now I'm trying to illustrate how incentives to recapitalize the bank actually affect the incentives to care about risk management quality in the bank. So again, let's assume agency problem away and consider simply a setting in which the manager incentives are aligned with shareholders' incentives, but now there is a possibility to recapitalize the bank at a reasonable cost. So the regulator in this setting is looking for the appropriate regulatory threshold that will maximize bank social value while preventing tail risk. So let me make a small point about this social value maximization. Actually, in this model, maximizing social value, bank social value, is equivalent to maximizing bank equity value because we have a fixed volume of deposits, and in the end, we can avoid any kind of systemic consequences. So the regulator will not bear any costs, and basically, it turns out that maximizing bank social value is simply equals to maximizing bank equity value. So, in order to be able to design the efficient capital requirements in this framework, the regulator must anticipate the response, the optimal response of bank shareholders to imposed regulation. And in this context, shareholders will have to make three decisions. First, when they are faced with a certain regulatory threshold, they will decide whether to undertake costly recapitalization at this point or just to accept mandatory liquidation when this prescribes. Then, if they prefer to recapitalize, how much new capital must be issued? So how much fresh equity must be injected into the bank? And the third point, the third decision they will make is about the quality of risk management. So let's start about incentives to recapitalize. Actually, in this model, it can be shown that shareholders will recapitalize the bank, but only at the point when capital regulation begins. So only at the point when bank asset value hits the regulatory threshold. So shareholders will always prefer to delay recapitalization as long as possible. And the scale of recapitalization, which is actually reflected by the scale factor, will be chosen in such a way so as to maximize equity value. So equity value in this model simply represents the expected discounted value of dividends net of expected recapitalization costs. That can be formally written in this way. So the regulatory problem is to select such regulatory threshold that will maximize the value of equity under the following constraint. And recall that we have seen this constraint when we were discussing the incentives of unregulated bank to take on tail risk. And basically this constraint tells us that the bank will stick to prudent risk management as long as the cost of imprudent risk management exceeds the gain from imprudent risk management. And also, part of the regulatory problem will be to anticipate the optimal recapitalization scale. And actually, just to give you a hint of the solution, this problem can be solved in two stages. So on the first stage, we can simply we can fix the scale of recapitalization. and we can look at the regulatory threshold that will maximize equity value while satisfying this incentive constraint. And basically, the optimal regulatory threshold will be delivered by the binding incentive constraint of bank shareholders. And on the second stage, so we can simply maximize equity value with respect to the scale of recapitalization and to uncover the final value of the regulatory threshold. So this is basically summarized by this proposition. So if it's possible to recapitalize the bank at reasonable cost, so it's also possible to design the regulatory threshold, to design capital requirements that will prevent the bank from engaging in tail risk. So how it works? The crucial thing here is that at this recapitalization threshold, the equity value remains strictly positive. And this creates this creates very important effect that will prevent a distressed bank from engaging in tail risk. So imagine, for example, that the bank is in a distress, so it's in this region, in the neighborhood of this regulatory threshold. And shareholders here, they know that if they engage in tail risk, they will lose the whole equity value in the case if a large loss materializes. So in this case, they will compare what will they lose and what do they gain from engaging in imprudent risk management, in tail risk strategy. And actually, because equity value in this region remains relatively high, the expected loss in the case if tail risk materializes will be quite substantial. So they will have something to lose, and this something to lose effect actually will prevent them from engaging in tail risk when the bank is in a distress. Now, one may wonder why shareholders would avoid tail risk when the bank is doing relatively well. Because here, when the bank asset value is relatively high, if a large loss occurs, so it doesn't necessarily bring the bank into default. It doesn't necessarily lead to wiping out of shareholders' equity. So, in principle, shareholders could afford themselves to engage in tail risk on this region. But here there is another incentive effect which enters into play, and this incentive effect is related to the expected recapitalization cost. The point is that if shareholders decide to engage in tail risk in this region, so they will anticipate that tail risk, the materialization of tail risk will deplete bank assets value and will actually increase the frequency of recapitalizations, thereby increasing the expected recapitalization costs. So they will anticipate that engaging in tail risk in the long run will increase the expected cost of compliance with capital requirements. And the anticipation of this extra cost of compliance with capital requirements will prevent them from having tail risk strategies when the bank is doing relatively well. So overall, having combined these effects, something to lose effects, and the long-run effect of recapitalization costs will help to completely get rid of tail risk if the capital requirements are appropriately chosen. So I don't have a lot of time, so let me go directly to the part in which we have the complete picture now. We have the agency problems present in the bank. And again, the problem of the regulator is how to discourage a bank from engaging in tail risk. But now the regulator has to care about the presence of the internal agency problem in the bank. So this means that now the regulator faces an additional problem. He must anticipate the expected cost that shareholders would bear so as to induce their manager to abstain from taking on tail risk. So basically, in this framework, when there is this internal agency problem in the bank, then shareholders must make two strategic decisions. First, they should decide whether overall to induce their manager to abstain from engaging in tail risk, and if so, how to compensate him in the least costly way, basically. they have to design the incentive compensation contract that will enable to prevent the manager from engaging in tail risk at a minimum cost. So I don't think I have time to go through the contract design, but so let me just make an outline of what I'm doing here. So basically, to deal with the capital regulation design in this case with the agency problem, first I'm looking at the optimal incentive compensation contract that will prevent the manager from taking on tail risk. So, and once I know the contract design, the structure of the contract, and the cost of this contract, I can integrate this information into the regulatory problem and to look at the choice of the regulatory threshold that would induce bank shareholders to implement this contract, to put this contract in place. And actually, in this model, the contract has a simple linear form. So basically, the incentives to the manager will be provided by the remuneration, which is linear on the bank assets value. So basically, the crucial thing will be the sensitivity, the choice of the sensitivity of this incentive compensation to the changes in bank assets value. And another important incentive demise that is really essential for the contract design is a threat of contract termination if a large loss materializes. So overall, the manager will be prevented from taking on tail risk because he will know that if he engages in tail risk and a large loss materializes, he will lose the whole contract continuation value, so any further compensation he can get. And basically this fear of contract termination combined with the appropriate choice of sensitivity of managerial compensation will completely deter the manager from engaging in tail risk. So once I know the contract design, so it's a simple linear contract, I can easily integrate the information about this contract design into the regulatory problem. So basically, now the regulator is choosing the regulatory threshold so as to induce bank shareholders to implement the incentive contract, to provide incentives to the manager. And you can see that the incentive condition constraint of bank shareholders looks similar to the incentive condition we have seen in the case without agency problem, but now we have this additional component which comes from which actually refers to the cost of incentive compensation. And also the cost of incentive compensation affects the equity value in this case. But for the rest, the solution of this problem and even the structure of the regulatory threshold looks very similar to the case in which we didn't have the agency problem. But now the only difference that we have an additional component, an additional component in the design of capital requirements, which comes due to the presence of this internal agency problem. And actually, it can be easily seen that so the higher is the degree of the internal agency problem, the higher must be the sensitivity of incentive compensation delivered to the manager so as to deter him from taking on tail risk. And because this is high, the threshold, the regulatory threshold or capital requirements which are established in the presence of the internal agency problem must be also higher. In other words, if capital regulation doesn't take into account the internal agency problem impact, it will be simply enabled to prevent tail risk because of this internal agency problem. So I'm running out of time, so I would like now to summarize the main ideas of this talk. So the point I was trying to make in this paper is that we are all bothered about bank managers who are taking too much risk, but sometimes we forget that the incentives to take or not take risk comes from shareholders. And basically the whole thing that sometimes shareholders do not care about risk too much because capital regulation is too lax. So the idea I'm trying to convey here is that in order to induce bank managers to abstain from manufacturing tail risk, it's essentially to induce bank shareholders to care about risk management quality in their bank. And to do so, I was trying to show that it's really essential to give shareholders incentives to recapitalize their bank. So if they are not interested in maintaining their bank operating when the bank is in distress, they wouldn't care about tail risk. They would just use these tail risk strategies as a gambling for resurrection tool, so as a way to escape the distress, to escape liquidation. Well, I'm not claiming that it's very easy to implement these private recapitalizations in practice, because, for example, in the US, shareholders are small-e dispersed, and it's not quite clear how to induce them to recapitalize their bank. There was a kind of legal proposal by Armati, Quincy Brown, and Victor Coulter, in which they proposed to create a special kind of institution. They called it liability holding institutions, entities for systemically important banks. And basically, the idea was that private recapitalizations can be undertaken by this the complicated mechanism of liability holding companies. And finally, another important point I made in this presentation is that internal agency problem matters for the effect, for the efficiency of bank capital requirements, and basically banks with a high degree of the internal agency problem between their shareholders and managers should face higher capital requirements. And this again applies very much to systemically important banks that have the possibility to manufacture the risk more than, let's say, commercial and traditional banks. And also in systemically important banks, this conflict of interest between bank shareholders and bank managers tend to be much stronger. So thanks a lot for your attention.
You use the phrase manufacturing tail risk.
Yes, actually, this is the expression by Cherry and Coulthers.
And in the beginning, you noted that a lot of the tail risk you refer to is actually a result of activity of banks.
Exactly.
As opposed to a pre-existing risk, which is simply reallocated and traded. But in the model, the tail risk you refer to is an exogenous source of risk, which is some Poisson process that would be lost. And this is, I think, a bit different because you, if the source of risk is pre-existent, then whether the bank decides to take on that risk or not doesn't really make it disappear. So when you look when you compare the case where the tail risk is taken on by the bank and it isn't, well, in the second case, you're just omitting to account for the presence of that risk because the bank doesn't take it on. But if you think of the case of insurance, forget 1 minute about banking, think of the case of insurance. Well, obviously, if a big insurance company insures some huge, risks, like catastrophic risks, obviously it's going to affect the balance sheet, so the risk, so the regulator should be concerned about solvency. But the other case, which is that the insurer doesn't simply insure that risk, it's not clear if that's a good outcome either, because then the risk is there, and if the insurance company doesn't insure it, doesn't mean it's a socially more desirable outcome. So here you get that it's more desirable not to take on tail risk simply because when it's not in the bank balance sheet, it's invisible in your model. But that doesn't mean it's necessarily good. If you think about it in these terms, pre-existing or not, I think what you referred to in the motivation was very interesting, but that's a case where you manufacture actually trade risk through the bank's activities. But the model seems to tell a different story because the risk is there anyway. I take it or not, it's my decision. But
it depends actually. We can argue differently. Indeed, one way to think about this important risk management technology is to say that, okay, there exists some pre-existing risk, and then it's not really related to this story of manufacturing tail risk. But we may also think about imprudent risk management as, for example, what the bank did when they took, so when they used securitization and they were providing subprime loans. Basically, in this case, well, this is my personal opinion, but I see the thing that they were manufacturing tail risk in the sense that they didn't care about the quality of loans, and actually this way, so the way they created this systemic risk, this tail risk, and they also took the exposure to this systemic risk because they ended up of buying the tranches of securities. So it really depends on the particular example we make for this imprudent risk management strategy. It can be treated in both ways.
No, my point is that in your model, there is no benefit in the situation where the bank takes on tail risk. There's no social benefit. I mean, in that case, the good outcome is that the banks avoid that tail risk. But in reality, there might be a benefit.
No, but there is more
from
benefit.
the bank insuring some risks. Think about it in terms of insurance. You see that there might be a benefit. So there's a trade-off there, which is kind of absent.
Here there is a trade-off because tail risk enables to generate the increase, well, the short-term increase.
But only for shareholders.
Only for shareholders.
Not for the
so there is
outside.
no any social benefit. That's
it.
completely true. So the only possible benefits are only for managers and shareholders, but for society it's dangerous. That's why basically we have regulation here is to induce this prevention of
but if you
risk.
take this and push it further, then you could also conclude that the bank shouldn't lend to low credit firms because it's risky.
Yeah.
I'm not sure if you would agree with
Well,
that. If you frame it this way.
here I can't really argue very seriously on this point because it's really partial equilibrium model, so I can't consider the whole welfare effect from it, but from this narrow perspective, I was trying to defend the position that tail risk is not desirable.
There is another
That is it.
question.
I'm of course all in favor of higher capital requirements, but I'm a bit uneasy about the word tail risk and about the approach that you're taking. The examples that you've given, subprime lending, securitization, are not exactly examples of risks that were objectively given or risks that could even be assessed at the level of an institution. But the reasons for why these things turned out to be so bad have to do with herding effects and with effects on market equilibrium. So that at some point markets for mortgage-backed securities just froze, or mortgage securitization no longer worked, and a lot of stuff accumulated in warehousing. And much of that was a system reaction to misbehavior, not just on the side of one player, but on the side of many players. So that what you call tail risk is not objectively given, but depends on what other people are doing as well.
So how many people are engaged in this similar kind of behaviors?
It's not just a problem of individual behavior, but of how the system fits together. Now, if I look at the way in which the people actually behave, I think you assume that they are far too rational.
That's right.
Part of the way in which this game has been played is that people tell each other stories about what's going on, and on the basis of these stories, they don't have any scruples about what they're doing. It's not that they're consciously taking these disastrous risks. Typical example, discussions in the mid-90s. People in the US, including in academia, were trying to tell me how wonderful this new system of mortgage securitization was and how it was revolutionizing real estate finance. I would ask, well, I don't really understand how this works, but if you form a package of such securities How does, say, the bank in Japan or the bank in Germany that buys this stuff know what the real estate property is worth and whether the borrower is a good risk? And the answer that I got at that point was, well, that's not an issue, because with these packages, through the law of large numbers, all risks disappear, which involved the linguistic corruption of confusing risk as deviation from the mean and risk as something dangerous. But it's typical. If you want to believe in a story, you do believe it. And that suggests that, in a sense, epistemologically, the problem is deeper than just moral hazard.
So you pointed that it's a kind of unforeseen risk hypothesis when agents didn't realize the risk they were taking.
People just tell each other or tell themselves stories about how the system works. So markets are always liquid because that happens to fit into our view of what risk management should be.
Well, I take your point, Sam. This is real life, this is ideal world.
There was another question here. Do you think?
Yeah, so one of the conclusions was that the quality of risk management matters, or should matter for regulation.
The conflict of interest between shareholders and bank managers matters. Actually, the fact that shareholders may think about it, if the manager wants to take on more risk than shareholders. So in order to incentivize him to abstain from risk, they must bear some costs of compensation contract. So if capital regulation is too lax, they don't have enough skin in the game, they wouldn't do that. So they would tolerate. So this is what I mean under the impact of this internal agency problem on the degree of capital requirements. So if capital requirements are higher, so there is more chance that it will force shareholders to take the behaviors of their managers more seriously. This is
The manager in your model have a finite time horizon or an infinite time horizon?
Infinite time horizon.
Right,
Yes.
because if that's not the case,
It's-
it would be
Yes,
different
actually
as well,
this is
right?
probably, well, this is not a limitation of the model, but indeed the manager remains in his position forever. And basically in the model it's an optimal outcome. So he may die or he may quit, but he's never fired.
No, but
Here.
also you are saying you discount the future payoff.
That's
While
true.
there wouldn't be, if they think they can make the future payoff from another employer, they wouldn't necessarily be that. Because you started your story saying that managers can change jobs very easily,
Well,
right?
yeah.
So if they
It was a bit confusing possibly, but here,
Yeah.
it's the single manager who continues for.
Is there any quick question?
So in the end, you said that one might need an additional institution because shareholders do not want to recapitalize or can't recapitalize. Could that really be the case? I mean, if the value of equity is positive, then there should be other people around who would be willing to recapitalize, right? And also problems like the leverage ratchet effect do not occur because if someone is always willing to recapitalize, then there is no risk. So debt holders of banks will always be repaid because the bank does not fail.
Well, here actually it's about, because I think your point is that we can always undertake a recapitalization by selling equity to some new investors, right? Well, it's one of the opportunity. Here I was more talking about how to induce existing shareholders to recapitalize. And the point was if they are dispersed and small, it's not so evident.
But it doesn't matter who recapitalizes, right?
In principle, it shouldn't matter so. Because in the end, yeah, it shouldn't matter. I agree.
Last question.
So I think this seems like a nice model. I was trying to figure out why this is a model of a bank and not just of any firm. And the basic underlying story is a Myers 77 asset substitution. I would call it asset substitution instead of insurance because you have this incentive to take on the risky asset when you're in trouble. I think that the reason it's maybe especially important for bank is that the risk control would be done in the bond covenants in the case of a firm, and maybe with the bondholders being private depositors, there's a role for government doing this. The thing that I think is missing, and this may have been related to the earlier comment, in practice, is that I don't think that you can, good bank regulation is going to rely on the competence of the management. That the managers having the same priors as you do and accurate beliefs is something that we don't want to rely on. I don't think that the leaders, I don't think the managers in Lehman thought Lehman was going to go under. So I think that that's probably a next thing to add, is to try to think about what happens when the management may have a rosy picture compared to what a reasonable regulator would have.
Sorry, I didn't get the very last phrase.
We might want to suppose that we have a manager who's very optimistic. There's some literature about how optimistic managers tend to get promoted and tend to be in high positions. Suppose that the manager is just optimistic and thinks everything's going to be okay in spite of these risks, and thinks that they're not so bad, but they are. I think we need to be protected against those guys, and not just and having just an incentive contract that says that they're going to do, that aligns their incentives with what's socially optimal, is not going to work for them.
Okay, so this is actually related to Martin's Calvic point,
Yeah,
that
it's related to
actions
that.
are too rational in this model. Yeah, indeed. So I buy this critics.
Thank you, Natasha.
Thank you.